Hi everyone, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profit service, coming to you from down here on a sultry day down here in Central Florida. Some rainstorms going through, followed by lots of sunshine, just very muggy out. Of course, as we all know, I like the warmer weather, so quite happy with it all down here. Lots of baseball the last couple of weeks. We're hosting a kid that's playing in the Florida Collegiate Summer Wooden Bat League. It's been a lot of fun going out to these games. Some great baseball, just a fantastic young man. If you ever have a chance to host one of these players, there's these college summer leagues all over the United States. I highly recommend that you do it. It's been a great experience for the whole family so far. Anyway, I was on the Benzinga pre-market show this morning. I love going on with those folks, some really good people, smart guys, love talking to them. But every time I'm on, there's the constant questioning. What do you think about this market? What do you think about gold? What do you think oil might do? And you don't want to just be overwhelmingly rude. This morning I went with the old duck and dodge technique, and I said, well, I'm probably more in the camp with Carl Icahn when it comes to stocks, who says it's not a matter of if, but when. Now, that is a brilliant prediction, okay, because all I said is it's not a matter of if. At some point the market's going to go down. It's just when it's going to happen. Didn't put a date on it. So now, when the market does eventually go down, I can go back and say, see, I was right about that. But I kind of try to duck and dodge it around it a little bit, because here's the answer. I don't know where the stock and bond market's going to go. I don't know where oil is going to go in the short term. Clueless what gold is going to do. I have no concept. I don't even think gold is really a big a store of value as we used to think it is. Gold, in my opinion, trades primarily on psychological concerns. Certainly not. It's not really that much of an industrial metal. Gold is popular and seen as a store of value because our ancestors liked bright, shiny stuff, and they could transact with it. And if you had lots of bright, shiny stuff, you could also get girls. So that's really the whole basis for the value of gold, near as I can tell. I have no opinion on it, but people like to talk about that short-term stuff. But I'm here to tell you, there's only two questions I ask myself each morning. I come into the office, I've got my coffee, I'm ready to go. Two questions. Are there any safe and cheap stocks that I can buy today? No? Okay, let's move on. Are any of my current holdings currently fairly or overvalued to the point where I should consider selling them? The answer is no. That's it. We're done worrying about what the market may or may not do for the day. Two questions. That's all you need. You don't need to be concerned about this day-to-day stuff. And a little later I'm going to get into why, as a value investor, you really don't need to worry about what the market's going to do in the short term. Practicing deep value investing has a tendency to take care of all that for you, but we'll get to that. Anyway, we did the National Association of Realtors had their commercial real estate report out this week, and solid report. They basically said, look, the markets are getting better, but we do still have a job situation. And everybody keeps talking about these great job numbers, but if you back out, as Louis Navalier pointed out to us, the double counting of jobs, this is not really a fantastic job environment. You still have kids coming out of college with way too much debt. So, it's not a great job creation that's going to spur a booming commercial real estate market at the moment. But it is slowly but surely getting better. Looking at the sectors, they're saying, retail, industrial, and office should all see slight decreases in vacancy rates and slight increases in rent for the year. And of course, multifamily is just booming because we talked about that. Kids coming out of college with too much debt, millennials staying at home and not really moving out, not a lot of family creation going on out there. So multifamily is just booming. Everybody wants to rent for now. There's a lot of scars left from the housing crisis, and they are not healed yet. People are very reluctant to jump into to selling and buying or selling a new home right now. So multifamily is hot, should continue to remain hot. This is actually fantastic news for us. If you look in the main deep value portfolio, we have some commercial finance vehicles, but in the income portfolio, which is actually doing very well, it's crushing the market this year, yielding a little bit over 7% total, fantastic total return portfolio. But we have lots of, we've got commercial real estate financing REITs, we have direct ownership REITs, we have hotels, we have real estate related equities, we've got a couple of apartment REITs, some student housing REITs. So improvements in commercial real estate are going to be a real tailwind for that portfolio going forward. If you're looking for income from your existing investment portfolio, 7% is better than most alternatives that you can find. And we've got a nice portfolio of safe and cheap stocks. We don't talk a lot about the income portfolio because it's designed as a set it and forget it. We rarely trade in the portfolio at all. We don't even really track too much of the earnings releases or noise and news coming out of that portfolio because it doesn't matter. We just want those stocks to sit there and throw off that income. How will it react to rising interest rates? I think it'll be okay. I think the REITs and the business development companies that are in the portfolio, as well as the dividend growth stocks that we have in there, will be okay. There'll be some market risk, but I don't think it'll be a huge problem for us. We've got a nice dividend flow to offset volatility in that portfolio. So it's worth checking out. It's part of the deep value report. It's just included, no extra charge. So if you're an income investor, you might want to check that portfolio out. The commercial real estate news really is going to be quite a tailwind for that portfolio. Now, guess what else it'll be a tailwind for? That's right, small community banks. A lot of the banks in our portfolio have a focus on commercial real estate and commercial and industrial loans, rather than competing in the just very crowded low spread mortgage market. They're branching out or have always been involved in the commercial side of lending. It's really helping a lot of these small banks. We saw it in the first quarter earnings reports as the big banks really having a hard time with it. The mortgage lenders, they're struggling. With the smaller banks, particularly the ones, again, with a commercial tilt to their lending portfolio, we've seen solid earnings increases, improving credit conditions. They were raising dividends, announcing new stock buybacks. We had just a tremendous first quarter earnings season because there is a high concentration of commercial lending in a lot of these little banks. So again, a very favorable commercial real estate outlook is going to be a tailwind for our small banks. Now, since I talked to you last week, we did in fact have another community bank takeover as Naugatuck Valley Savings got bought out at a very healthy premium. Gives us a 50% gain from our original purchase price. It was a classic small bank trading down under 85% of book value, very low levels of non-performing assets, very high equity to asset ratio over 10, and several activist investors involved. It was kind of a matter of time for that bank. Well, time's up. Liberty Bank bought them. It's an $11 a share cash deal. 50% gain for our subscribers, so we'll take that. That gives us so far this year, between the portfolio banks and our teeny tiny bonus banks, the ones that are too small to be in the portfolio, because we can't guarantee that everybody could get shares. They're that small. It can be $15 million and under in total market cap. But two of those have gotten taken over. So there's 4 takeovers this year with an average gain so far of 52%. That's not too bad. That portfolio is beating the market this year and over the last year rather handily at this point in time. So don't know why you guys aren't all running. There's like 8,000 of you on the list. I don't know why all of you aren't running to subscribe to Banking on Profits, but you absolutely should be, because this is where the money's going to be made with what I think will be the least amount of risk for the next several years. Remember, when rates do start to go up, the community banks are a major beneficiary because their net interest margins will start to go up and they'll make more money. If rates are going up on a sustained basis, it means the economy is getting healthier, and that means that you're seeing more loan demand. All positives for the small banks if interest rates start to go up. So that's the sector you want to be looking at. You should be a subscriber. Go to marketfi.com and sign up if you haven't already. We're seeing lots of great activity. We're seeing the dividend increases. We're seeing the buybacks below book value. And just in the last month, I think we've seen 4 new 13Ds filed by activist investors in some of our stocks. So you probably want to be involved in this. Okay, now let's talk a little bit about the cash levels in deep value and international deep value. It's over 50% in deep value right now, and it's about 40% in international deep values. We found a few more things in Europe last year that were still cheap enough to catch our eye. We get a lot of criticism for holding a lot of cash in the portfolios, but here's how this works, folks. When we did all the studies earlier this year, and we've talked about some of those, we've got some ongoing ones running as I speak. What we found is value investing provides very, very lumpy returns. Okay, the process works something like this. For the first, I'm going to say 3 to 4 years after a market bottoms, and maybe shorten that up to 2 to 3 years. I don't have the exact numbers in front of me. Value outperforms by an enormous percentage. I mean, it's just when you're using deep value, focusing on book value and liquidation value, those types of things, you have outrageous outperformance for the first few years after market bottoms. As the market continues to rise, you tend to come back in line with market returns. And as markets top, you tend to lag because you can't find anything to buy and everything in your portfolio is getting overvalued. So cash levels come up. There's a very natural timing element to deep value investing. It's not forced. There's no squiggly lines on a chart or anything. It's just a function of you sold all your stocks that are now fair or overvalued, and you have no place to put the money, so your cash levels build. Now, you can look at cash one of two ways. One, cash is a risk. It's a drag on performance. And you know what? Big surprise. International value is keeping pace with the market right now in spite of the large cash levels. And that's due to the European financials that are really getting a boost from quantitative easing activities over there. And of course, international regular deep value is lagging by a couple percentage points so far. The cash levels have really helped us. Some of our deep value peers, Church House Investments over in London and Aegis Value, which is a fantastic fund out of Virginia, have gotten really hammered in the last year with losses over 20%. That hasn't happened to us because we don't have an institutional mandate of any sort. We don't have to stay fully invested. Now, I like to look at cash as James Montier does. It's a tool. It's something for me to deploy when prices do come back into reality, and in fact there are bargain stocks to buy. So rather than worry about the risk of underperforming for a period of time, I'd rather have the cash as a tool to buy when markets inevitably, remember, if not when, right, do come back into line, decline, and there's lots of bargains around. And keep something else in mind, guys. It's not just the fabulous brands or the high return on equities or all the stuff that you see attributed to Warren Buffett and Charlie Munger that have made them so rich. Yes, that's part of it, okay? But let's be honest. They got real rich first by buying deep value stocks until they couldn't scale the size of it anymore, because most of our stocks tend to be smaller market capitalizations. They're crash buyers. They sit around, collect all that cash that Berkshire Hathaway generates. They've got $68 billion in cash right now. And they just sit and they wait. And what they're waiting for is a substantial market decline. They're waiting for a crash. And you think about Warren, the famous Coca-Cola purchase. He drinks lots of Coke, wonderful return on equity, great company, one of the world's greatest brands. But take a look at when Warren Buffett started buying Coca-Cola, folks. He started buying it post-crash, 1987. Started intensely buying it in 1988, while the stock was still incredibly cheap as a result of the crash of 1987. Okay? Now, think back to Warren in 2008 and 2009. He was cutting deals with Goldman Sachs, Bank of America, everybody for these special convertible preferreds. He was buying financial institutions. He was buying basically everything he could get his hands on at that point in time. He had accumulated all that cash. The crash came. All of a sudden, Warren was an aggressive, enthusiastic buyer. Charlie Munger, all that cash piling up. And Charlie double dipped, okay? Let's be honest. Daily Journal made an enormous amount of money in 2007, 2008, 2009 because they print the legal journals. And that's where you run the foreclosure notices. So their editions were running extra size and were collecting all those fees for running those notices. He piled up all his cash. And in 2009, he took the money right near the market bottom, and he bought banks and a Korean steel company. And they've compounded it over 30% a year over the last several years. He's a crash buyer, guys. When Warren Buffett says some people take a simple idea and just make it too difficult, this is what he's talking about. You're looking to buy assets and earnings when they're cheap. They're not cheap after a 6-year extended bull market. There is very little that you can point to in the market and say, that's a cheap stock. There's some great companies out there, to be sure. For instance, my wife and I are regular enthusiastic users of Netflix. We love some of the series on there. Same with Amazon Prime. That series Bloodline, by the way, they just did set in Isla Morada. Fantastic TV. You should watch it. But they're not cheap. They're great companies, but they're a long way from cheap. Now, when the internet crashed and Amazon convertibles were trading at 30 cents on the dollar, that was cheap. We bought those and eventually did really well with them. You've got to sit with your cash until there's an opportunity. As Munger once said, it is hard to sit there with all the cash in your accounts. But he didn't get rich by chasing mediocre opportunities. All that's out there right now, for the most part, are mediocre opportunities. There's not a lot of safe and cheap stocks. Great companies are wildly expensive. Blue chips are about as overvalued as I've ever seen them. So you let the cash pile up. I don't know if it'll happen tomorrow, a month from now, a year from now, but eventually you will get an opportunity to buy stocks at very reasonable prices. And that's the point in time when we will deploy the cash that is currently in the deep value and international deep value portfolios. Until then, we'll just go along. We'll find some stuff. We thought an infrastructure company that's going to really benefit from increased water related spending in the United States going forward. And again, that's a not when it's if it's going to happen. That's a when it's going to happen, because the infrastructure in the U.S. is getting in worse shape every year. We're going to have to spend the money eventually. It was traded at 80% of book value. Financials were great. It was a classic, safe, and cheap stock. We bought it. That was about 2 weeks ago, but we're not finding a lot, guys. We're just not. And I'm watching a lot of the stocks in the income and deep value portfolio are starting to show the kind of gains maybe we should take a little bit of that off the table so we can actually see cash balances in those portfolios rise over the months ahead before we do get some type of inventory creation event. We've got lots of cash. Cash is a tool. I'm happy to have it as we approach the end, 6th year, 7th year now of a bull market. You've got all kinds of turmoil in the Mideast. You've got quantitative easing in Europe. You've got Mr. Putin doing pretty much whatever he wants. You've got a Russian-Chinese alliance. China's kind of scribbling back and forth with Japan. Lots of geopolitical hotspots. We have no idea what's going to happen with interest rates. So there are external risks to the market. There's not a lot of opportunities, nothing cheap. So I'm real happy to sit here and underperform with a pile of cash. The whole idea of this is to invest a lot of money when the markets are cheap and have a lot of cash when markets are high. And deep value investing forces you to do that until we get that severe market correction or inventory creation event, as I like to call it. I'll just sit back with primarily lots of cash and small, cheap community bank stocks where there's an activist involved. That's like being dealt aces in a game of Texas Hold'em. I'm quite content to sit back and do that. I'm pretty sure it's going to work out real well for me over the long run. Anyway, that's all I've got down here in Central Florida this week. There's another college league game this evening, so I'll be trying to catch that. And until next week, have a great week, and we will talk to you then, guys.